Morning folks, welcome back to Meaningful Money. I'm here at the Merry Maidens, just a little bit west of Penzance, a ancient standing stone circle. No idea how long it's been here, but it's ancient, and I imagine it's a source of sort of earth energy or something like that. Maybe, I don't know, we'll press her on a ley line. Better not stay here too long else I'll fall pregnant. Now, we're going to talk today about shares. Shares is something that most people know a little bit about, even if they've only heard of them. And what a share is a tiny slice of a company. Shares are sometimes given other names. Stocks, you might have heard the phrase stocks and shares, or equities. And that word equity is perhaps more often used when talking about a house. So if you have a house worth $150,000 and a mortgage of $100,000, then the bit that you own, $50,000, is your equity. And it's the same with shares. What you're holding is a tiny bit of the equity of a company, of what it is worth. So companies are usually, certainly big companies, the companies that you've heard of, Tesco and M&S and things like that, usually divided into hundreds of millions of shares. So if you've got a couple of thousand, then you don't own very much of, say, Tesco. Now, owning shares confers on you, the owner, some rights. Firstly, it gives you a right to vote in the affairs of the company, how you think the company should be run. And it also confers on you a right, usually, to a dividend. And what a dividend is if the company makes a profit, it can distribute some of that profit to its owners. It can give you some money, and that's a dividend, usually paid quarterly, but more often half yearly. What it does not confer on you is the right, for instance, if you've got Tesco shares, that doesn't mean you can waltz in to the store and just start nicking things off the shelves. Neither does it mean that you can sack the really annoying checkout person who insists on talking to her friend when she's supposed to be serving you, much as I'd like to do that on many occasions. But you can't do that. It doesn't give you any rights to run the company. You can't gate crash a board meeting and decide that things should be done how you want them to be done. You vote on the affairs of the company, and one of those is appointing board members. And the board of directors are the people who actually run the company. So what it essentially gives you is a right to vote on the affairs of the company generally, and a right to a dividend. Now with shares, how they are valued on any given day is down to a couple of factors. Usually a company is worth something, it has assets. So if we continue taking Tesco as an example, it has stores, it's got property, and it's got a whole load of stock. It's got liabilities as well, it's got people to employ and pensioners presumably, but the actual company will have assets, so it's worth something in real terms. But what stocks and shares are all about really, and what, to be honest, most investments are about, they're only worth what somebody is prepared to buy them for. So their valuation is entirely based on supply and demand. For instance, there we go. If I want to sell you this stick, it's a nice stick, but if I tell you it's worth £100, you, if you've got any sense, would, laugh me out of town. You'd say, well, I'm not paying you £100 for a stick. And because I want to sell it, but you don't want to buy it, this stick is essentially worthless. But if you're a stick collector, you might think that this is the nicest stick you've ever seen and be prepared to pay me £100. So you've got the demand, and I am going to supply you with this lovely stick. And so the valuation of this stick is all about supply and demand. And it's the same with most investments, and it's certainly the same with shares. And that is why the stock market, the place where shares are bought and sold, goes up and down, and up and down, depending on sentiment, buyers and sellers. If there are more buyers than sellers, the price will go up. If the reverse is true, the price will go down. Sentiment is notoriously fickle. We can use BP as an example. Obviously, they've had a nightmare in the Gulf of Mexico with the oil well bursting. The tractors come round again, so I'd speak up for a bit. But that meant the value of their shares has plummeted because of the massive cost of the cleanup operation. So people don't want to buy BP shares anymore. In fact, they want to sell them. And they have done. Hang on. There's another tractor going past the road now. This is the problem with doing this in public places. That's a little better. the price of BP shares has gone down massively because people want to sell them. Could argue it's a good time to buy, probably about 6 weeks too late actually, but never mind. So what we just talked about there are ordinary shares, tiny slices of the company which give you a chance of a dividend, the right to vote, and which the value of which is determined by sentiment. Those are ordinary shares. Now there is another kind of share, and they are called preference shares. They are rarer, but what a preference share does, it gives you preference over the dividend. So if a company's made a profit and there is only so much money to go around, if you hold preference shares, you'll get the first slice of the pie. In theory, but that's how it should work. You've got preference over the dividend. If the company goes bust and has to be wound up and assets are sold off, if you are a preference shareholder, you get the first slice of any money that's left after paying off the creditors. So there are benefits in a preference share, but what a preference share does not confer is any right to vote. So they're different, they're rarer, there's less of them around than ordinary shares. Most people hold ordinary shares, but they both have value in any decent portfolio. So that's how shares work. What a fund would do is buy shares in lots of different companies, as we talked about 2 or 3 videos ago. So that's how they work, that's how they're valued, that's why they go up and down like most investments. So hopefully that's helpful. We'll keep coming back to shares because they're such an important part of any decent portfolio. But for now, from Merry Maidens, thanks for watching. Next time we're going to talk about property, a subject close to many people's hearts. Thanks a lot, see you next time.